ASC 840's executory contract approach faced criticism for enabling off-balance sheet financing, reducing comparability. This led to a joint project by the Financial Accounting Standards Board and the International Accounting Standards Board, resulting in ASC 842 and International Financial Reporting Standards 16. These standards require lessees to recognize assets and liabilities for most leases over 1 year, enhancing transparency and comparability. Under ASC 840, the executory contract approach faced criticism for enabling off-balance sheet financing, reducing comparability. This led to a joint project by the Financial Accounting Standards Board and the International Accounting Standards Board, resulting in ASC 842 and International Financial Reporting Standards 16, which require lessees to recognize assets and liabilities for most leases over 1 year. ASC 842 became mandatory for public companies after December 15, 2018. Condor Company enters a 5-year non-cancelable lease with Dunaway Inc., paying $79,139.18 annually. The asset's fair value is $312,418.40, with a 10% implicit rate. The residual value is $20,000, unguaranteed by Condor. The asset reverts to Dunaway after 5 years, and Condor uses straight-line depreciation for similar assets with a 6-year life. A lease qualifies as a finance lease if it meets any of these criteria. Ownership transfers to the lessee by lease end. The lessee has a purchase option likely to be exercised. The lease term covers most of the asset's economic life. The present value of payments equals the asset's fair value, or the asset is highly specialized. In operating leases, the lease liability is termed as an operating lease liability. The lease expense recognized mirrors that of short-term leases. For instance, in the Condor-Dunaway scenario, applying operating lease treatment results in similar accounting for lease liabilities as finance leases, but with distinct expense recognition. Lessees must present right-of-use assets and lease liabilities separately on the balance sheet for both finance and operating leases. Operating lease expenses appear in income from continuing operations. Finance lease interest and amortization are treated like similar obligations. On cash flows, right-of-use assets are non-cash activities, with finance lease repayments in financing and interest in operating activities.